Hey, good morning, traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. We appreciate your time and taking time out of your busy Wednesday mornings to join us. Can you believe we are already at the final trading day of August, which means monthly candle close is upon us. Stocks turned sharply lower on Friday following commentary from Fed Chair Jerome Powell at Jackson Hole, with markets quickly pricing in a slightly more aggressive Fed. As you can see, bottom left-hand corner of your screen, futures are off the lows from yesterday. We'll take a look at the wave count in just a few minutes. We knew going into the wave 3 or wave C high that we had anticipated a pullback somewhere between 4050 to 4100, and clearly we've overshot that, which seems to be a similar theme or a common theme for the year, in that we also overshot the wave 3 objective on the upside going into that reversal. So we'll get to the charts in just a few minutes. Before we get to the charts, we're going to bring in the trading analysis team. Give me just a second here. Good morning, Terry. Good morning, Alex. Good morning, Todd. How are you guys doing today?
Morning, guys.
Hey, guys. Good morning.
Welcome.
Hey, guys.
How goes it? Everybody doing well this morning?
I hope we made the most of summer. It's over here in the Northeast. I know it's different for you guys, but yeah, no, everything's good. Fun markets, and it's one of those markets like the summer. Sometimes summer's so boring and dull. You know, traders can kind of step away and do something else. This was one that kind of kept you engaged all summer. So it feels like it was busy. But
yeah, there's been a lot going on. A lot for the markets to digest. It's been a bit of a volatile year. We've made some really good traction off of the June lows. So anxious to see where this takes us.
Yeah, it's a good discussion. I'm looking forward to this one. I always look forward to joining you guys. Thanks for having me. And but this is gonna be a good one. So hit it.
Absolutely. Good morning, Alex. Good morning, Terry.
Morning.
How are you guys? Doing well? You guys ready to rock?
Still wet.
Alex, you there, bro?
Still raining here. Still raining in Texas.
Oh man, I tell you what, we got like a decent flood. I sent you some videos yesterday, but yeah, Terry's got some fun stuff. We'll share that in just a few minutes. I'm going to take you through the charts. I think Alex is getting connected. We'll take you through the indexes. We're going to take a look at the S&P. I'm going to take a look at the Nasdaq. We'll also take a look at the Russell 2000 small cap index, as well as the Dow Jones. And then we'll be back on the other side. Gentlemen, I'll catch you in just a few minutes. Anything specific you would like me to cover chart-wise? Same goes for the chat.
You asking us?
Yeah.
Are you asking us, or are you asking the
team?
Semiconductors always getting close.
Yeah. I'm gonna show you my interpretation on semis. It's interesting, and then yeah, I mean, you have a short on. We put that out there publicly, right? I mean, I just, you know, so yeah, it's gonna be a good discussion. I'm looking forward to this. You're short the market. I'm looking at a possible support level. We could go higher or lower here, and I think there's like a 50% chance of that.
Totally agree. Yep.
Yeah, it's interesting. So yeah, no, hit it, man.
All right, sounds good. I'm going to take you into the indexes. We'll be back on the other side. Catch you in just a few minutes. All right, let's hit it. Hard right edge of the trading analysis edition of the MotiveWave platform. We'll go full screen on the charts, starting it off first with price action in the S&P 500. And as you know, we've been tracking two overall primary interpretations of the markets. At this point, even in the event we see a break south of uptrend invalidation, we are not looking at the 2022 decline as a motive sequence. So what that suggests is that even in the event we break this support zone and we do violate the 36.36 low, we would then be viewing that as simply another three-wave corrective journey lower, and view that as a viable low and a tradable entry opportunity. So we are not looking at this as a big wave one down and a big wave two retracement. In the event we are met with an unexpected catalyst, perhaps that view could substantiate and eventually materialize, but we just don't see it. There's been some really solid progress across the board when looking at tech and discretionary names. The semiconductor industry group has made a sizable move up, and the move off of the low in the SMH, unlike the indexes thus far, does appear to be motive or trend establishing. So looking at the S&P 500, last week we discussed the fact that we were essentially up against the exact same decision that we had coming off of the late March high. The index is declined in 3 waves, found support February 24th, up in A, down in B, up in C. We knew at the time that this could potentially be a move up in 1, back in 2, up in 3, down in 4, and then up in wave 5. What ended up happening is wave 4 violated the price territory of wave 1, which means as markets sold off into the April 11th low and then retraced in 3 waves, that essentially confirmed a breakdown to new lows. So we've been up against the exact same pattern. We have a move up in A or 1, down in B or 2, and up in C or wave 3. Now the bearish downside trigger from an impulsive perspective would be 39.4586, meaning if the S&P 500 were to break under 39.45.86, in my view, that would set up and begin to confirm a break south of 36.36 and possibly take us to 3600, or my more extreme downside target near 3400. But we don't know yet if this has been 3 waves up or if this has been 5 waves up. We did a really good job of identifying the kind of ending wave 5 sequence inside of this green wave 3 or wave C. So let's get off of these charts and I'll take you down to a smaller 1-hour time frame and we can dissect the development that we've seen thus far off of the low. And here we can see, I have them both labeled for you. Down on a 1-hour time frame, bottom left-hand corner of your screen representing the June 17th index low, where we have a move up in A or 1, down in 2 or B, up in 3 or C, and this is either down in 4 or the start of a new impulsive trend to the downside. So what we had identified was an ending contracting variety diagonal. We actually took a short position with our clients August 16th, about an hour before the market ended up topping, looking for the start of this wave 4. Now, when it comes to the wave 4 support zone that we identified last week, which essentially starts at 40.5 and takes you up to 4100, we have clearly violated that zone on this downside move. In addition to violating that downside support zone, we've also moved south of the corrective trend channel, and we've actually turned it into resistance. Generally speaking, corrections will be contained within parallel trend lines. So right now, we are just above invalidation of the impulsive trend, and it is beginning to look more directional and impulsive to the downside as opposed to an overall corrective wave. Now, there's a couple of positive takeaways here in regards to the bullish impulsive wave count in the index. Number 1, the wave 3, as mentioned, did overshoot its upside objective. The upside objective came in at the 1618 relationship to wave 1. August 11th, which was a Thursday, the market actually sold off about 50 points from that 1618. In my opinion, trying to trap traders into viewing that as the end of 5 of 3. Fortunately, thanks to viewing the S&P through the lens of the Elliott wave principle, we were able to identify the fact that that was only a 3-wave sequence, and that should, in fact, not complete the wave 5. So that 3-wave move actually set us up for an ending diagonal. If you follow me on Twitter, August 16th, we identified the NDX ending diagonal. So we gave you the pullback zone. So we overshot on the upside. Now we're overshooting on the downside. And as mentioned, we are just above invalidation of trend. Another positive takeaway regarding this being wave 4, even with the overshoot, is the fact that it's technically supported based on the guideline of alternation. And what I mean by that is, even though this is technically a zigzag structure in wave 2, given that there's 5 waves down in A, 3 back in B, and 5 waves down in C, instead of a 3-3-5 subdivision, even though this is technically a zigzag, it's a more sideways development, where the B wave was better than 78.6%, or a better than 786 retracement of the A wave decline. So the guideline of alternation would say, you know what, a more directional 4th wave in this zone would be appropriate. Zooming in here on the 1-hour chart, I want you to pay attention, and I'm going to take you right to the 15-minute time frame. If we take a look at our corrective trend channel, which takes us from the August 16th high through the August 26th X wave high with our parallel trend line over the wave W low in this instance, you'll notice that as we actually gapped under that particular trend line, we moved back up and we've now since turned it into resistance. So I do think it's becoming a bit questionable if this is in fact an overall 5-wave rally in the S&P. And we know as an alternate, if we were to break south of here, we would have to be viewing this as some sort of series of 1-2-1-2 developments with the 39.45 trigger on watch. Over to the Nasdaq 100. Here in the case of the Nasdaq 100, we are tracking the same two interpretations on the daily time frame. Here we have a move down that has significantly overshot support. We're at about 161% relationship to wave 2, and we've seen, gosh, about a 61% retracement of the overall third wave rally. Wave count invalidation, again from an impulsive perspective, 12,175, spot 98. That's the level I will be watching to the downside of the Nasdaq. Over to the Russell 2000 small cap index chart. Here we are again, 1 hour chart. Bottom left-hand corner, June lows up in 1 or A, down in 2 or B, up in 3 or C. In this case, we actually had that same ending diagonal of the contracting variety into a 786 retracement. ABC down. So far, in the case of the Russell 2000, we are right at equality of C compared to A, which is typical of a correction. Yeah, it is fairly deep in regards to a retracement of 3 or an equality projection to 2, but it's not wrong at this point. Okay, so that's the S&P, the Nasdaq, Russell 2000. The Dow Jones Industrial has technically already overlapped the price territory of wave 1, which does leave open the possibility of a leading diagonal, which we discussed with our clients. We might get to this discussion in just a few minutes. And then finally, I'm going to wrap it up with the SMH. You know, looking at the SMH and looking at this chart of Apple, these are two charts that make it very difficult to be bearish this market. And I think we can all agree that that is the case, just given the magnitude of this rally back in Apple. This looks very much so like a wave 4 position. Over to the SMH, we have kind of a similar story being told here in that the decline for the year has been contained within parallel trend lines with 5 down of A, an expanded ABC, and a ending contracting diagonal in wave C. You'll notice, although we did exceed equality of C compared to A, the corrective trend channel that we discussed in the other wave count is exactly where the SMH, every time it interacted with it, tried to find support. Yeah, we ultimately overshot it, but then as we overshot on the third test of, we ended up rallying to the tune of 30%. In the case of the SMH, I see this as 5 up and some sort of a complex correction back. You could even move this green 1 over, and you could call this orange 4 over here and some sort of a flat in the wave 4. Really doesn't matter. The implications are going to be very similar. And then if the SMH were to break down, 7 swings up, ABC could present a move to new lows. But again, as Todd mentioned out of the open, it's really a coin toss in the current levels. So we're going to take it one wave at a time. We shorted on the 16th, put an additional position to work with clients. The additional position was just simply a risk management equation, talking a 20% risk for about 200% reward. So fairly favorable to take a stand ahead of the potential invalidation of the impulsive trend. So that's it for me this morning. Back over to the team. What do you guys think? What do you think? Wave 4?
It's a tough one right now. You know, just got to keep in mind it's the last weekend in summer. Trading desks are still thin. And I think, you know, just not to get too much on the Fed, but, you know, the Fed, I think, is using their words as a weapon. I tweeted something yesterday. It's almost like they're talking loudly and carrying a small stick. Mm-hmm. You know, I think the Jackson Hole thing was I think those are sharp words from Powell saying households are going to feel pain. But at the end of the day, all that happened was the Fed funds rate, the terminal rate, the rate at which they're expected to stop, went from 3.75 up to 4, and they're still only unwinding 1.5% of treasuries and mortgage-backed securities from the balance sheet. You know, starting in September, like not much change. So I think the Fed was really trying to push the market around in a thin market that is, again, a lot of traders in the Hamptons, Hawaii on the West Coast, maybe the south of France and Europe, you know, and maybe where else, Dubai, I don't know. But the technicals are there. I first and foremost, I'm always looking at the technicals, know what's going on. But I feel like the Fed was trying to push the market around and use price action, the wealth effect, as one of their tools. So I think that needs to play in. That doesn't dictate what's happening on the charts, but that needs to be a factor.
Yeah, I totally agree. That's a great assessment, and very similar to what we discussed with clients on Friday, given the fact that really not much changed, and it appeared to be, at least Friday, a bit of an overreaction going into the weekend, and that's why we continue to respect either scenario moving forward.
Yeah.
I agree completely. I think it's just a Fed narrative. And I think the next CPI in 10 days will prove that to be just a narrative talk.
And I think the market's now. Oh, go ahead, Alex.
Yeah, all commodity spectrums, which we are going to show later on macro, are down. And I think that will be reflected in the CPI. And I think this is just a pure narrative, as you explained.
Yeah.
That's also my take.
And the Fed is already behind on their MBS, their mortgage-backed security roll-off. Like, they're not going to be dumping mortgage securities into a collapsing real estate market, even though it's been so strong. So the Fed already sees what's going on. The market's now trading on the fact that the Fed might go too far, as Greenspan did in late 90s, hiking rates into the tech bubble, and then he went too far cutting rates post-tech bubble. It was like an 8-month lag from last time he hiked rates, and then he went into a series of 50 basis point slashes, did too much without letting it go through the market, and that precipitated a housing bubble. I think the markets are worried about the Fed just going too far, too much, without letting it filter through to the underlying economy. And so we're trading on recession fear, prolonged recession, deep recession fear, not inflation. The narrative is shifting already. And maybe the Fed will not screw this up and sort of back off, provided we see inflation data start to come off, as you said, Alex.
Yeah, also there is one factor. I mean, I looked one assessment that every move in rates on the upside increases a current debt about the 300 billion. So
I saw that.
That's something.
I saw it.
Yeah, that's something which is kind of enormous, So that's also one of the big factor of overshooting with rates on the upside. I don't think the Fed is so oblivious to that fact as well. I understand the strong wording, but I think just a fake. It's a fugazi, how they say, it's a woozy.
Did you say fugazi?
What is the word?
I love you, man. Serbian, national using. That's great. That's a perfect description. And perhaps the markets are trading, government spending, and the Fed is perhaps trying to monitor government spending, because I think it's getting pretty aggressive here before the midterms, and maybe the Fed's trying to keep inflation at bay from spending that's happening at the top. So that could be part of it too, and I feel that's gonna change soon. So anyway, let's flip it over. Let's keep it going, and it's a good start, Bennett. I'm gonna push back on one or two things just on your interpretation, and let's talk about this real quick. And I'm gonna hit Terry's world for a sec on our RRG. This is the weekly RRG. This is benchmark against the S&P. And I think what's interesting is the value. So value is down here. This is the top 200 value stocks. Boy, that's a hard color to read. Which one is that? I got to get closer, man. I think that's mid cap. And then here's the 2000. So this is like the Russell 2000, the small cap for value. Is that mid cap value right there? What's that one? Yep, that's 2000. And then mid cap value. Yep, that's mid cap value right there. So value is rotating out and moving from weakening to lagging quadrant. Crossing this 100 level on the ratio means that value, starting back here in like April or May, has been falling out of favor, whereas growth has been rotating in. And what's interesting is if you just look at the growth ETF, Okay, so you just look at this one right here that I just pulled up. It moved into the leading quadrant on a week-over-week basis. So even though the market is selling off, you have to keep in mind that the market has seen a pretty clear rotation back into growth. And then as TH just mentioned smartly in the comments, the Russell, something doesn't square up with the Russell, the small cap. Look at the position of Russell 2000. So not only is growth leading this market, but small caps, which traditionally have a higher beta to the index, are leading. I have a hard time getting bearish on this market in a late summer market where I think the Fed is trying to exercise an agenda via price action in a thin summer market where growth is leading. And you also have crude oil back on an 8 handle now. As Alex just said, I don't think the markets are afraid of inflation. Inflation is I think there's enough evidence out there to say it's coming off and future reports are going to be lower. And we have growth rotating in. So I think that's something we have to sort of factor into, the excellent wave work that Bennett is doing. From there, I want to talk about, the other thing I forgot to mention, I'm on CNBC today at 2:45. So talking about 3 stocks, one of which I hold in our portfolio at the RIA. Okay, so here's another thing. I tweeted this out yesterday. Look at the internals. Okay, the internals are showing some pretty good divergence. So this is the tick, NYSE tick. And what I like to do is throw a moving average over the tick. So this is the amount of advancing stocks minus declining stocks on the NYSE. It's a way to show institutional buy-sell programs. Institutions are still the ones that move the market. So when you have a big buy program, you usually get over an 800,000-900,000 tick reading, which means 1,000 more NYSE stocks are upticking versus downticking at that particular time. And I like to throw a moving average over there just to smooth it over. And you can see as the S&P here in, was it August 23rd, made a new low. Look at the moving average at the tick, clear divergence higher. So you're not getting the institutional sell programs in this most recent push down in the S&P. And then the other one that we're seeing a divergence is advanced decline. Same deal. So the S&P here in purple, the advanced decline, amount of advancing stocks minus declining stocks at the close of that particular bar, right? So we're seeing a higher low here in advanced decline. And then I think the other one was put to call ratio. So this one, you got to flip your mind upside down because the put to call acts like this. Okay, so as the S&P in purple here declined, you'd expect to see more puts being bought than calls, which would put this indicator at new highs, where you can see compared to this guy, this high here, we've made a lower high. So the protection is it being bought in the options market with this latest push down. So you have 3 clear indicators, and actually you get a few more that say we might be moving into support. And also, by the way, you look at September options in the SPX, there's huge open interest both on the put and call side at the 4,000 strike. So that's going to be a battle here. That's September monthly. So it's, we still have 2 weeks to go until then. And then the one thing that I did want to show is Bennett touched on it, is the semis. I think the semis are really very, very key in here. And there's something that was interesting. I think I touched on this last week at the show, guys, and I said the semis were moving to support. It was right about here. And I thought this might have been the 5-wave move down and wound up just being 3, I think, of C. I was wondering if it was 1, 2, 3, 4, 5. It was too shallow. But NVIDIA came out the next day, and earnings were terrible. Guidance was terrible. And everyone says, oh, sell NVIDIA stock. But NVIDIA was up like 5% that day. Okay, so it was a good reaction post-earnings. We did ultimately go down and make a new low. But, if you just look at this is the same point that I made last week. This is SMH into the Nasdaq. In fact, let me just do the S&P. It's probably better. So this is the semis semi SPX ratio, and you can see as the semis came off the low, the ratio is moving higher, leading the S&P, and then all of a sudden, now we're getting the semis leading the index on the way down. Okay, so semis are in a position of leadership. You have to take your cue from there. Comparing it to the Nasdaq, same deal. Okay, but we are starting to move into potential wave 2 support, and it doesn't match up like Bennett mentioned with this being a wave 4 and this being a wave 2. This is clearly a 5-wave move up with A, B, expanded flat down, and C. And then, let's just take our Elliott hats off for a second and realize, like, we have broken resistance that's now offering support. Back in my early days as a tech analyst, I used to kind of call it the ski jump setup. You'd come down, break resistance, come back as support, and get launched. Right. So the semis are moving down into support. And then, Bennett very clearly talked about the deep support here in the Nasdaq. So I'm not going to go back over that. And then one thing I wanted to push back. So there's that wave 4 support, same deal with that broken downtrend channel resistance. So you have support, support, support. You do a parallel line. This is a great way to see sort of hidden trend lines. You have a downtrend line that's very clearly in play here, and then you just parallel it, put it off the swing point high, and then you've got support down into potential wave 4 support there. And I gave Bennett a heads up ahead of time. I was like, look, what about the possibility that we're doing not wave 4 down, but what if it's a higher degree second wave and we are doing a leading diagonal leading diagonal up? It is 5 waves. It is 3 waves in 1, down in 2, 3 waves in 3, down in 4, 3 waves in 5. And, I have the fib ratios on top of there. And according to Prechter's interpretation of R.N. Elliott's work, wave 3 needs to be longer than 1. Wave 5 needs to be longer than 3. There's typically an overshoot of the 2-4 trend line up in wave 5, 1-3 trend line up in 5, which we've clearly gotten. And then we're pulling back into some kind of deep support zone here. So for all those reasons I mentioned, growth leading, moving in, crude oil pushing off, the market's afraid, the Fed is going to push us deeper into recession. And we've got some technical support. I'm wondering if that might be a possibility. What do you say, Bennett, on that?
Yeah, I don't push. The only pushback I would have, and I'm not overly bearish. I hope you know that. I've been fairly optimistic with the move back up in semis. Technically, the leading diagonal isn't valid.
Okay.
Because it would be of the contracting variety, which would call for progressively shorter segments of the wave structure. So 3 would have to be shorter than 1, and then 5 would have to be shorter than 3. Is
it though? I mean, where do you? Okay, so that's a good question. What swing points would determine that it is expanding?
So with your third wave being larger than 1, if 4 was then larger than 2, then we could justify 5 being larger than 3, if that makes sense.
That's a good point. So 4, see, and listen, I'm going to follow my story. Would you say you basically learned Elliott for me in my early days? Would you at least
100%.
give me that before?
100%. Yeah.
The teacher is now being taught. Okay, so that's a good point. For this to be valid, 4 needs to be larger than 2, correct?
Correct. Since 3 is larger than 1. Yep.
Got it. Okay, good point. Good point. So being that 4 is shorter than 2, that would make it an expanding diagonal. Expanding leading diagonal. So actually, technically, it's not valid.
Yep, it's the same rule set that we were discussing on the leading diagonal down in the S&P that we're not viewing as valid right now.
Got it. Okay.
But I will say, Todd, of all of the patterns in the Elliott wave principle, I think the leading contracting variety diagonals are the most subjective and open to perhaps interpretation. Yeah.
Yep. Nope, good point. Yeah, we'll see what happens. So yeah, I mean, you have the short on. Don't disagree, and I still have. You can take it off. I'm done. I still have a good amount of cash in the wealth management side. We had about 20% in July, at the end of July. I put some money to work. I still have a good 8-9%, and specifically in the growth fund. If we don't hold these immediate supports, I am looking to go back and put an inverse ETF, a hedged on, which I had through June and July to hedge. So I'm watching this closely. We have clients that are sitting on cash upon their request, and we have cash built into the models. I'm getting texts from them say, are we putting money to work, putting money to work? And I'm watching every day. So either we're putting money to work, we hold support, or we are going to go lower, and we might need to do a little hedging. It's interesting in here, man. They can't give us the summer off.
I know. It's a unique one. It's a unique one. But regarding that open interest at the 4,000 handle in the index, that would actually tend to favor the idea that perhaps this is 4, we go up in 5, then ABC back in wave 2, and we're trading around that range for a period. And then also on your leading diagonal, we could justify wave 3 was August 16th, and this big pullback is the larger 4th wave, and the entire diagonal.
You know, I thought that.
Yeah.
Yep.
Yep. I like that as well.
It could be, yeah. So this is wave 4. Yeah, that's point. And then, okay, so in the NDX, that's going to be like a 12.20. We need to break that in order to start to qualify as 4 moving into 2.
Yep. 12.175, I think it is. Yeah, 12.175.98.
12.175. Yep. Yeah, that's a good point. Yep. And that's the thing we do, guys. You know, there's no right way to say here's exactly what's happening in the markets. If you approach the market and say with certainty here's what's happening, you know, and I look at the Twitter idiots who don't engage in this good debate going back and forth that Elliott and technicals and fundamentals and analysis of the market is some degree of science and math, but there's a lot of art and subjectivity and psychology behind it. So for you to say one person's interpretation, provided they're not breaking any rules, it's just wrong. This is the kind of debate you need to have. And this is why I like to surround myself with such smart guys and girls who can, engage in debate. And that's the best way, I think, for price discovery, market discovery, and find yourself in the right position. So, don't take our indecision and back and forth as we don't know what's going on. We know what we're doing. This is part of the process.
That's right. It's how it works. All right, we're getting Mr. Long set up here. Yeah. Screen is your direction. You ready to rock?
Yeah, I was telling clients the other day, I said, don't get married to any single wave count, and exactly what you said there. The whole work process is to look for the rule violations, look for those not the right look patterns. And that takes time and experience working these charts in all these various modes. So Todd, I want to thank you again for teaching me this technique. It was something I had been struggling with for years. I found you, and you just opened the whole world up to me. So thank you very much.
I appreciate that. Well, thank you. I appreciate it. It's very sweet, guys. Nope. I learned from people before me, so there's really nothing new under the sun. So, nope. It's good.
Yep.
Enough of this fluffy nonsense.
We are all lovers of the Elliott Wave principle. Good old Ralph Nelson Elliott. May he rest in peace. All right, Terry, you ready to rock?
Yes, sir.
All right, let's hit it. We've got about 2 minutes until the open. Take it away, and we'll be back on the other side.
Okay, hello traders and investors. I'm Terry Long at TradingAnalysis.com here with your weekly sector focus. So, summer trading is rapidly coming to an end. Can you believe it's already August 31st? Now, not that it hasn't been an interesting summer, but I will say for the first time in several years, the old saying, sell in May and go away, wasn't far off this year's. We saw the indexes dip in June only to rally back to those May highs and by mid-August before starting this next leg lower here. Now, this market data here includes Monday and Tuesday's price action in it. The S&P last week ended sharply lower, down 4.04% following Jerome Powell's brief commentary at the Jackson Hole conference last Friday. The NDX had a net decline of 4.82%. The indexes are now working a corrective retracement after this nice summer advance. Now, last week, the energy sector rose 5%, though it did pull back some on Friday, along with all the other sectors. And the materials sector managed to remain positive for the week with a 0.42% gain. But all other sectors were in the red, with the technology sector hit the hardest. It was down 3.42%. I don't think my bars are in the right place here, but that's okay. I think there was something wrong when I took this picture. This is not where this purple one is the S&P. It was down 4.04%, but the technology was down worse than that. Let's go ahead and fast forward to this week. Now, Monday, we just heard the bell, the opening bell there. Monday started off with the markets taking a breather from Friday's big push lower. And Tuesday, though, saw the indexes resume their corrective decline. Now, in these first 2 days of trading, the S&P is now down 1.76%, and the index is down 2.08%. Now, energy reversed its fortunes sharply as crude oil pulled back 5% on Tuesday. So it was up 5% last week, now back down 5%, settling in at about $92 a barrel. I didn't look at it this morning. We'll see what it's doing. Let's move on over here to the sector leaders scoreboard. Now, this summer has seen the technology sector, just as Todd was talking, advance up the ladder in our relative strength scoreboard and actually move over here into the leading quadrant. It's the only sector currently holding a position in the leading quadrant on the weekly time scale. Now, the energy sector, we know, had a strong hold for much of the year, but over the summer, it's been racing towards the lagging quadrant. Animate that back a little bit. You'll see now with Monday and Tuesday's price action added in here, we are starting to get a northerly hook forming in this very last tail segment. Now, again, the last tail segment here is only 2 days long with the markets just now opening, but we are seeing a rising momentum before energy was able to get to the lagging quadrant. Energy stocks, I believe, are attempting a recapture of, or just not ready to give up that leadership position just yet, and they are attempting to recapture or move back up in here. I will say utilities, healthcare, staples, technology, energy, and industrial sectors do all have a higher relative strength currently than the benchmark S&P. But again, only the tech sector is traveling in a positive heading while all the others continue to shed relative strength position. Again, energy now moving due north. Industrials, I don't read a lot into the heading direction here on the industrials tick because the tail is so short, but I will give it the credit that it does have a slight northeasterly tilt. It's just very close right here to the origin, which means typically it's going to behave very similar to the benchmark. Now, over here in the lagging quadrant, real estate, financials, materials, and yes, communications. The communications sector broke back down from the improving quadrant, penetrated back into the lagging quadrant, just not ready to take a leadership position. Now, up here in the improving quadrant, and the lone sector in the improving quadrant is the consumer discretionary sector, which is sporting a strong northeasterly trend with a blue improving weekly price trend vector. We look to see the stocks in the consumer discretionary wanting to follow along with technology. And again, that's another one of your growth sectors, communication being the third, and part of healthcare. Part of healthcare actually is considered some of growth. And so healthcare still has a high relative strength, but it has a lower momentum right now. Now, the real estate and the financial sectors, they've been moving slightly northward. The tails are short. They really don't have any kind of inertia that they want to, that's showing me that they want to jump out of this, except for just this week. These past 2 days, we also are seeing a little bit of a, let's go back there, a little bit of a sharp tick there in the financials back to the northeast, but currently, relative strength remains underperforming. The materials sector looks to have started to recapture a bit of momentum, but again, continuing to lose a relative strength. Now, is there anything special you'd like me to look at, Bennett? Otherwise, I'm going to pass it back to you.
If you could open
will
up the
say-
SMH really quick and just show me the weekly.
Yeah,
the
let's
weekly.
take a look here. The semiconductor. So again, I'm going to say I've got the Heiken Ashi candlesticks flowing on my chart here, and these are dailies. And so I can read these, the downtrend is in place here, though this last candle looks like the momentum to the downside is slowing a little bit. But yeah, we've had a thrust to the downside. I believe you and I are still optimistic that we are going to get a completion here and then get the semis back on order. What else do you?
Yep, I definitely
See
would
there.
not fade that. Would not fade that chart. How does the weekly RRG look? What's the grouping like currently?
It's not as strong as it would like to be. I think a lot of these semis are still organizing themselves, but again, we do have several already holding leading conditions. ON semis got a nice northeasterly vector running there. Cadence with the highest relative strength in the group. KLAC is showing momentum fade, but it still, again, has high relative strength, which is really the price action. Now, Qualcomm was one of the first semiconductors that actually jumped out in the lead. It did weaken a little bit. Let me animate that for you. It did weaken a little bit after coming out of the improving quadrant, and once it pushed into the leading quadrant, it does look like there is a little bit more uptick coming back in it. Now, I think Global Foundries is a semiconductor that Todd brought to our attention here a while back. It's got a beautiful hook that formed about 3 weeks ago. Northeasterly vector, blue, rising, improving trend, and actually accelerating. The tail segments are, the velocity factor there is getting longer, which means that it's getting acceleration push higher.
Very good. Much appreciated, Terry. Thank you so much. Yeah, it's really interesting to see within the SMH. We've got Applied Materials, we've got AMD, we've got Lam Research, we've got NVIDIA, Texas Instruments. Oh, I got to get back to that. Hold on. Coming your way now. They're all showing the same five-wave setups. So check this out.
Yeah.
Terry.
Well, we have GFS in the growth portfolio. Put that one on, one against us, but it's come back very well relative to the semis. Yeah, look at that baby.
Isn't it beautiful?
Oh, well, good things. All I can say is good things come to those who wait. So
Congratulations
I got
on that
on
new
the
ride.
list to order this baby back in October, and it finally arrived last Friday. So yeah, this is the 2023 Corvette C8. It's a Z51 3LT. It's got all the bells and whistles. I'm halfway through the owner's manual. It's got so many bells and whistles in it. I've got to read it. Now, the sad thing is, when you buy a new car, you just don't want to take it out in the rain and get it dirty. And it just hasn't stopped raining in Texas, and the weather forecast says it's going to keep raining for another week. So poor baby's sitting in the garage. I tried to take it out of the garage twice this weekend, and within 2 minutes, it instantly started raining on it. So all I did is pull it back in the garage. Yeah, I'm looking forward to some nice cruise.
It hurts you starting it up, and the rain. You shook the rain loose from the clouds with that exhaust. I love it. Beautiful ride, man.
Yeah.
That's beautiful. Congrats. That's awesome.
Hey, when
I was driving
go ahead.
I was driving
a
Camaro. I love that baby. That was my last car was a Camaro 2SS. It also had the Corvette engine in it, so I'm used to the power. But I think I made a nice upgrade. So.
Oh, for sure, without a doubt. We'll have to run it down a runway sometime.
Can I have a lap?
It probably will go faster than your plane.
Oh, for sure. What's up, Alex? I missed
Can
that.
I have a lap if I come to Texas,
Oh.
Terry?
Oh, absolutely.
I'm coming.
I love it.
Amazing.
I think it's time for a trading analysis Texas meeting. I think we're getting pretty close. I think we're all
without a
traveling
doubt.
now.
Yeah, without a doubt.
Yeah.
All right, Alex, you ready to take it away?
Yeah.
All right, let's hit it. Markets are open. We've been open about 9 minutes, hanging out just shy of that very key 4,000 handle. We'll see what happens. Take it away, and we'll be back on the other side to wrap up.
Hey guys, hello. Let's just go quickly over a couple of macro things. So we're going to start with the 10-year yields. The charts didn't change so much, so I'm always trying to form a macro picture marrying this couple of fundamental things and technical picture that I'm seeing. So this also corresponds to the view that we are very close to the levels where the rate's actually going to undergo of a smaller or a larger collective pullback, and I think technically this is very close. I'm going to show you also a couple of other things why I think that the subject we talked about on this stream is also going to actually kind of see this CPI number lower, because when I look all of the commodity spectrum, the prices are already for weeks on the lower end that we see them a couple of months before. So this is the 10-year yields. We are tracking this wave count for already a couple of months, and I do see this either as a small triangulation or a small upside movement and then a start of reversal. I have been tracking the European rates. The Jackson Hole European crew was very bullish on the rates in the ECB. They're lagging too much, and this chart has been shown many times here. We label this as a wave 4 because from the lows we have seen the progression of this intermediary, very vertical uprise, which we usually characterize as a wave 3 of 3. And that has been a pretty nice development from the support levels of this trend line, forming this wave 3 on the upside. So I think the ECB is lagging, and it's going to stay lagging behind the Fed because of the situation in Europe. But I do see a potential 5-wave formation with a lag in the ECB or in the European Union. And after that, we're going to go undergo a sizable correction in rates in Europe as well. So the chart that many things are depending on is definitely a dollar index chart. I've seen a couple of levels that most likely we are going to test. I think we are in a very late stage of this uptrend. I do see this moving potentially further a little bit more on the upside if we don't reverse immediately from here. Some of the readings that we have seen are pretty high, looking the almost 40 years back. If you look this RSI on the monthly chart, which I tend to look, and if you compare a couple of other highs that we have seen, we are actually very close to these levels where we have seen a sizable reversals before. Also, the wave count we are tracking is actually confirming that we are, even if you take this as an ABC and we are in the Y on the upside, you will see a large move down in an X wave or a B wave, or you're going to see actually a larger correction down to these levels starting very soon. And I do see that also in a couple of currency pairs. So when you do this cross assets analysis, you can see many of them actually unfolding in a similar manner, announcing reversals in one another. So if we also look the commodity spectrum, you will see that also oil is moving lower. If we see Thomson Reuters index, which is in a B wave correction, it's going to move lower. When we see the prices of the nat gas, we are still hitting 1618. Here, potentially wave 4 might start soon. When we see also soybean picture, the prices are moving lower. When we are seeing also wheat picture, we are far below the highs that we posted when the Russian-Ukraine conflict started. And we also, when we see the corn picture, we definitely, after a 5-wave move, we see a 5-wave move downs with a potential even lower prices. So I do think this will be actually seen in the CPI numbers that we are going to see come, I think, around 13th of September. And if we see significantly lower prices, the last print was at 8.5. If we see something around 8 or even below, I think the Fed will stop this so much aggressive narrative and kind of start to be more softer on the next Fed meeting, which will ease off this strong narrative that we discussed about. When we switch to metals, we will see that gold and silver still doesn't display a confirmation on the upside. We still watch a potential development here in a first 5-wave move from the overall lows on the daily chart. So we did identify this as a potential flat, and this is a regular flat, which is a kind of a rarer flat versions in the Elliott Wave world. And from there, we are looking for some type of a larger time frame confirmation, which actually will prove that yields might go lower. From the last couple of years, gold proves to be more acting in deflationary environment. So we might see this confirmation potentially very soon. If we also look the silver chart, silver didn't actually succeed to trace out the clear 5 waves up, confirming the change on the uptrend. I have some targets around 1673, from where I do expect the first 5-wave formation and confirmation of the larger of the uptrend. So my take will be that I completely agree with Todd. I think this is just a very strong narrative because of the fear of the Fed, and I think they're just using the narrative. If you see all of these charts, the position of the US dollar, the position technical of the rates, the position that we see on a Thomson Reuters index and many of commodities, as you know, these lower prices still needs to be shown into the data because they lag. So I do think this will be shown in the next CPI, and I do think this will soften the strong narrative that Jerome Powell was exposing. So that's from me, guys. So tomorrow, Crypto Lab, lots of interesting things on crypto. So if you want to see what's going on in crypto world, please join me on the same trading analysis channel. So back to you, Bennett.
Very good. Much appreciated. 9 a.m. Eastern, right here for Crypto Lab. Please join him. All right. Excellent work, team. Any final words of wisdom before we let him get out of here? We've got 13 minutes until our weekly member webinar.
Yeah, I see the communications sector jumping 2.2% this morning. Look at those numbers coming out of Snap, Meta, Netflix, even beating down Roku.
Netflix picked up 2 key executives from Snapchat, so I wonder what that means. Are they going? Are they moving into more of the social realm? Netflix is leading comms up 5.3%. And I'll tell you what, that chart pattern Netflix doesn't look too bad. Everyone just kind of left Netflix for dead. It's starting to show a little some signs, and EA's in there as well. That's one of the stocks when we talked about on CNBC at 245 is Electronic Arts, which we do hold, and there's a little buyout rumor going on there. So yeah, some good stuff happening in comms.
Very good. Appreciate you all tuning in. We've it's been a good show. We'll be back same time, same place next week. We will also be, Alex will be live tomorrow morning, 9 a.m. for Crypto Lab. You can check us out anytime at tradinganalysis.com. Alex, Terry, Todd, solid work. We'll see what the markets bring. Catch you guys same time, same place next week. Have a good one.
Enjoy that ride, Terry.
You know it.
Yeah.
Be safe. Be safe. All right. We'll see you guys.
Nah, drive fast, take chances.
Have fun with it. Have fun with it.